The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and/or through separate funds and may change their holdings at any time.
Welcome, everyone, to a new episode of This Week in Intelligent Investing. Great to have you with us again. Great to have my co-host, Elliot Turner, and a special guest today, Alex Morris. Elliot will introduce Alex to all of you. I'm sure many are already familiar with Alex and his new book. That'll be part of what we'll talk about today. So, Elliot, why don't I turn it to you?
Great. Thanks, John. And thanks, Alex, for joining. I'm really excited to have Alex here. It's been fun to get to know him, and it's been fun to follow TSOH, both the Twitter feed and the Substack over time. So Alex recently published Buffett and Munger Unscripted, 3 Decades of Investment and Business Insights from the Berkshire Hathaway Shareholder Meetings. It's a fantastic book that compiles the key insights from the meetings going back to 1994. Much in the same way that Lawrence Cunningham, once a guest of this pod, had done with the Berkshire letters, arranging it by topic. And I really love that because you effectively get a manual from the master on each domain in topics like value investing, capital allocation, circle of competence, etc. Everything you'd expect from Buffett and Munger and more. So I think it's really cool. Major props to Alex for taking the initiative, kind of like imagining this product and imagining this concept and bringing it to all of us as a treasure. So beyond that, I really like the TSOH research site. I love that the name is derivative of Ted Williams' book on baseball, hitting a baseball, which I think is basically one of the hardest things to do in the world. Big baseball fan myself. I know we've talked about that on the pod here as well. And I really like the companies and the way Alex covers them. So, Alex, welcome to the pod, and thank you for being here.
No, thank you for the very kind intro. You had me thinking about. For someone who had never any professional aspirations or likelihood of doing anything in any sports, I was generally a decent athlete, but hitting a baseball was one thing that always gave me some trouble. So you made me think of that as you were describing Ted Williams's books. So maybe I should have read it a little bit younger. But thanks for having me, guys. I'm excited to be on the pod. I'm a big fan.
Oh, yeah. Well, you're either born with that skill or you're not. In some ways, there are ways you could learn how to be better at hitting a baseball. But I'm better at slapping a puck than I am hitting a baseball.
Yeah, I didn't have whatever you need. I didn't have it, I guess.
That's right. But we could all appreciate it. And I play fantasy baseball, so I do get there in some way, shape, or form. Wanted to talk about the book first. I'm curious, what made you think to do this? Because it was a big undertaking and it's pretty neat.
Yeah, well, I guess for one, I maybe potentially underappreciate significant of an undertaking it might be. I kind of stumbled into it. For a period of time. I was, kind of just doing it for deriving insights on obviously a wide range of topics that I thought would be interesting for my own personal knowledge, or also for, as it got to the later stages of the project, ideas that I could use for write-ups at TSOH Investment Research. So it kind of started in that manner, and then eventually it reached a point where it went from being a little bit more of a side project that I was working on to, especially once I kind of, like, approval is not the right word, but I got to kind of the go ahead from Berkshire in terms of, hey, we're okay with you doing this. Once I had that, I kind of had to take it obviously much more seriously and actually get it done within a reasonable amount of time, because I started working at Harriman House as well. So it kind of stumbled from being something that I was doing more so for fun and for insights into, I actually need to kind of get this done. But overall, it's been the whole project, generally speaking, was enjoyable when I wasn't on a time crunch. I mean, I was thinking of an example here as before I came on today, I was listening to you guys a couple episodes ago talking about basically the big CPG companies and how that business has changed over time. And, I was just flicking through the book too and got to this section about Warren talking about Kirkland at Costco being a $39 billion business and Kraft Heinz being a $26 billion business, and just kind of contextualizing like what that means. I mean, it's just one example of almost everything I read or that I kind of see day to day. There's parts of the book that are kind of relevant that I can come back to, and that usually shed some insight on that topic. And a lot of times I look at the date of the meeting that the comments were first made at, and I go, man, Warren and Charlie, they didn't always make the perfect decision, but in a lot of cases, they kind of had a track for how things were developing in a certain way that was many years, and in some cases decades, kind of ahead of where general perspective was. So it's always interesting in that kind of framing too.
I really love that little Kraft Kirkland example because it's like a small anecdote, but it's profound. And it's exactly the kind of material that you wouldn't get from a Berkshire letter, but you would get from Warren and Charlie Unscripted on stage, just off the cuff. And it's a deep insight too. So I'm curious, just in general, like I would imagine immersing in the content as you did would lead you to appreciate certain things in like new and different ways. What are some other like really big lessons you picked up in taking on this project?
Most of them sound silly when you say them out loud, which I guess is how these things kind of work, right? But the idea of management incentives and thinking about how they think about, in particular when they buy a business, right? How they think about structuring those incentives with a manager versus how you see these things normally dealt with in the world of, especially large publicly traded companies. I don't know as much for small companies, but large public companies have a certain way that compensation tends to work, that when you compare it with the way that they describe how they compensate managers and how they think about things like cost of capital or, charges for capital being used in that business, it just makes it so clear how a lot of the things that are done in corporate America are basically nonsensical. And a lot of times are just backing into a desired answer and are not really aligning incentives in a way that makes sense necessarily with what shareholders or long-term owners of the business actually want. So those type of things are really apparent. This also comes back to the conversation you guys had on the CPG companies. Another thing that really shines through is thinking about certainty as part of maybe not the valuation exercise necessarily, but underwriting a business and underwriting an investment, and thinking about that in the context of the price that you're paying. Capital allocation obviously ties into that as well. And this idea of, capital allocation and managerial decision making kind of driving the future direction of the business, the sustainability, the moat, et cetera. So how Warren and Charlie thought about that, and really, again, how they implemented it when dealing with other people, whether in the context of public companies, but even more so in terms of companies that became subsidiaries of Berkshire. I think in those situations, it really shines through how they thought about some of those key questions.
I love it. I really miss my our former co-host Phil when you talk about incentives and capital allocation as like two main pillars there, because I think if you'd go back over our episodes historically, they're probably two of the most prominent themes, derivative of Berkshire's perspective on the topics, and definitely it's almost like a manual, not just for investors but for operators as well, for operators of public companies and the stewards of public companies on our behalf. That's so interesting. And your point on certainty, I mean, that's my theme of these last 2 years, where I'd had this bias toward really pretty spreadsheet math, but had to reorient my focus toward the value of certainty, the value of resilience, and it definitely could appreciate those. I'm curious, as you were going through the years, were there certain years to you that stood out as especially profound? Ones where you're like, I want to come back to these over and over again, or like as you're listening, I got to hit rewind and like hear that again and again.
Well, there weren't many that I wanted to re-listen to, only because I had listened to so many of them that I needed a bit of a break. But I think the meetings that they've put out the recordings for go back to 1994, and I think the first 5 or 10 years to me really stood out as the more insightful. I think that is partly a reflection of the timing in terms of who they were kind of talking to, the audience, at first, even just the audience in the building, right? But over time, the audience being anybody who could watch. I think they were with Yahoo, right, for a live stream. At some point, the audience just kind of changed. The questions kind of changed from the shareholders, but then also when they changed the meeting to have, reporters, and I think Doug Cass, a short seller, they just switched up the questions in a way that the audience became different. The nature of the questions became a bit different. And obviously there were things going on in the market during the 90s and then into the early 2000s that were particularly interesting in terms of what people were asking them about. So I think that's the period that to me really, really stood out the most in terms of a lot of interesting discussions.
Yeah, so I went through your page after the table of contents where you have like by topic which year you cited each meeting. And I figured it was a fun exercise. I just counted up which ones you quoted the most and tried to look for which ones you didn't quote. I thought it was interesting. 1998 got the most quotes in the book. Curious, do you recall anything offhand that like really made 1998 stand out?
I'm trying to remember now. I mean, obviously they were getting hit with a ton of questions about tech and this idea of them not being invested in where the world was going. And, it also led to a lot of their explanations on how they thought about Berkshire and how they managed it and whether or not they were the best person to kind of express a view about a certain segment of the market, basically, which those conversations, the answers are more pointed than a lot of things that Warren in particular would say over time at the meetings. But I thought it was a really interesting framing in terms of how he thought about what their role was. And if people wanted something different or some sort of specific thing in like a submarket, they can go out and find it themselves or do it themselves. I thought those kind of discussions were really interesting. It also coincides with a period where Berkshire had made the significant investment in Coca-Cola and the stock had done so well, with some of that attributable to the improvement in the core business, but also a very significant tailwind from the multiple and the valuation. And so you're kind of running these parallel paths of the market moving in a certain way, but also some notable holdings moving in a certain way, and Warren kind of navigating that discussion, which, obviously understandably is somewhat difficult for him to do, given he's not particularly interested in saying certain things about Coca-Cola in that position, right? So I think that component of it all was really, really interesting in terms of how they kind of approach those discussions.
That's really interesting. Yeah, and it's funny you started with like internet, but like I thought it was kind of notable that there wasn't a single quote from the year 2000 itself. Was there something about that one? Was it like too much focus on .com and things that weren't timeless at that time?
It's funny. It's hard for me to remember now. I'd have to go back and look through my notes. What part of it became difficult because, to the extent that there were questions about a topic like that, they had already answered it in a way that was complete enough. And as I went through the editing process, I basically, as a general rule, kept the earliest reference to a topic to the extent that the answer kind of fully covered what needed to be said. So I think for a lot of those discussions, or that topic in particular, had already been addressed in a way that was complete. But that is interesting. I'd have to go back and look and see, exactly like the mix of questions during that particular meeting.
That's an interesting point on you focusing on the first instant in which material was covered. I'm curious, like, how hard was it to, when you'd compiled everything, go back and say, like, maybe I should put certain pieces on the chopping block and narrow it down? Like, how hard was it to sift through everything and then do it again?
Yeah, once I got this sense from the editor or publisher, and I kind of agreed with them on the length, that it was, I wanted it to be complete but not like unnecessarily overbearing, and that obviously meant on a bunch of topics like value investing or something that I needed to really try to chop it down. I think I had a good enough sense of, from having listened to them long enough and having them listen to them repeat answers on certain topics, I had a good enough sense of what they perceived to be kind of the key points of what they were getting at. And, certain answers obviously would would trend in other directions, or even could be split off and put into another section, which I did at times. And I could cut the first half and have that already been covered somewhere else. So I don't remember it being overly difficult. But during the editing process, I sure had to, it's hard when someone, especially someone like Warren, when he's talking. Well, for one, there's times where he starts sentences and then goes in a completely different direction. But there's also times where he covers like 3, 4, 5 different topics over the course of like a 3-minute answer. So I had to figure out exactly what to do with those. And I could reprint them all in one place, but it's not particularly easy to read something that's kind of presented that way. More often than not, I found a way to kind of chop those up and move them into different sections that would hopefully make it more, digestible for the reader.
Very interesting. And, as you were listening to all these like meetings at once, like close together, were there any patterns that you noticed, like any patterns that stood out to you that you hadn't noticed listening to them, like, each year and then moving on and forgetting about it?
When you say patterns, like give me an example of what you mean. What do you mean by patterns?
Any kinds of questions that led to thoughtful answers, any kinds of, like, you talked about Warren going on these like little starting on one topic and moving to another, like was there any one evolution in those kinds of tangents that he'd go on? Or I don't know, curious if anything stood out on that front. I feel like
I think it comes out in the 90s period. There's the one answer where he talks about, there's X number of companies above this market cap level. I can't remember the exact numbers now. Maybe it's 50 billion or something, right? And he kind of lays out exactly what you're implicitly saying in that price at a given required rate of return, and lays out how many companies actually, it goes out 3, 4, 5 years, whatever it is, and says, hey, here's how many companies actually earn that amount of money of net income each year today. And here's how many companies are valued at a price that kind of implies that they'll get there in 5 years. And it partly gets to, in my mind, how, and I think this is somewhat true in how he's expressed certain bets over time. I mean, Apple comes to mind, IBM comes to mind, a bunch of the wholly owned businesses come to mind. And I think he's probably said this explicitly, I'm sure it's in the book, this idea again of certainty and thinking about growth as good thing, bad thing, or indifferent. And I think he, generally speaking, starts from the perspective of growth not being anywhere close to the primary determinant of investment. It's that combination of certainty and then price with capital returns, basically, or an understanding of how the cash flow dynamics are going to look. And if growth is part of that, that's fine. But I think he's very clearly focused on that question of, if this business is going to, grow 5% a year over the next decade, that's fine. What are the cash flow dynamics inherent within? And again, this is all really straightforward, right? But I think it's things that he keyed in on over time as being particularly important to the question as he saw it. And again, I think it's expressed in how he talks about, or a certain number of bets he made. I think the capital return situation at Apple around the timing that he did it, or maybe a few years earlier, was a very important part of that equation. I think the same is true at IBM. Clearly lays out that was the case at PetroChina in the early 2000s. And then at the wholly owned businesses, it's apparent that he expresses that same view in terms of, again, the comp structure and the price that's paid for those businesses. So that part to me really shines through as he thinks about position sizing and the key variables of a bet. The certainty of the cash flows is something that is very top of mind.
That's really interesting when you take it from the perspective, that 98 meeting that was the most cited, talking about not investing in technology. And meanwhile, he could point to the certainty of the cash flows in something like Apple, and one of the more phenomenal investments ever. Do you view that as like somewhat contradictory, that Apple ended up being so great an investment for Berkshire?
Well, I think the capital returns part of the equation probably lived up to what he expected, right? And I think he was also, to be fair, I think he was pretty explicit on his views, at least over time, about how he thought about the pricing power in the core, iPhone business, right? So I think that's pretty clear as well. How he thought about the multiple and where it was going to trade and things like that. Obviously, I'm less sure about, but I think I think that combination of the core business here, he probably had a reasonably good feel on the volume trajectory, at least in a general sense. He probably had pretty strong feelings about the pricing power, which I think he's explicitly discussed. And then obviously had a pretty good line of sight on what the capital returns are going to look like. So those three components, I think, are probably fairly deserved returns. And then the last bucket, obviously, I don't know if he foresaw the multiple going from, what was it, probably 10x cash, maybe below 10x cash to 30 or so, whatever the number is. Maybe he didn't foresee that part.
And IBM, I mean, he bought it and gave up on it. I think, I don't know the exact math on it now, but had he held that, I don't think the return would have been all that bad as of today, though that return almost entirely would have come in the last year and a half. What do you think made him give up on that? I know I'm asking you to speculate here, but
yeah, well, as someone who, I won't say I tailed him into it, but I did own the stock on a what I would assume is probably a somewhat similar thesis. I think it became apparent enough in time that, at least from my perspective, as someone who also owned Microsoft during that period, and I still do own Microsoft, it became apparent to me that, to the extent that these companies were in a somewhat similar market, IBM's position in that market relative to other notable players was clearly heading in the wrong direction, at least on a relative basis, and at least for a period of time. Not to say that they're necessarily direct competitors in everything they do, right? But I think that became apparent. That was also evident in the financials, and I also think there was a lot of adjustments and non-GAAP stuff going on to make the numbers what they were. That just wasn't as clean. Not to say it was necessarily wrong. But I think that just reached a point where, and again, it gets to what you guys discussed on the CPGs, right? When you get to a situation where that certainty of the core business in terms of something that can be closely described as volumes is then dealing with the price question, and those are interacting with each other in a way that you're worried about the thing starting to go in the wrong direction. That changes the story very, very, very quickly. And I don't think that didn't feel like it was completely out of the question, at least in my mind, at some points during the, call it, early 2010s on a name like IBM. So I would speculate that maybe that had something to do with it.
that makes a lot of sense. And it would have been a long, hard slog to see it through to better days. So that, to the extent that he likes that certainty and some degree of visibility, it really wasn't there. When you think about, like I'd asked you for patterns, but I'm curious, are there any notable changes that you observe going through the material?
Notable changes. I think generally speaking, they kind of stuck to their knitting. Obviously, it would be nice if we had earlier meetings. I think that would be interesting, or at least easily accessible. They might be somewhere that I don't know about. I think one of the discussions that was interesting. I'm not going to remember this perfectly. I'd have to go back and read it. I'm looking right now. It's on page 214 of the book. But I think the discussion around NetJets and what went on in that business is an example of maybe being willing to test that certainty thesis a little bit. I mean, my recollection of how it went, and again, people can go read it directly to see whether or not I have this right, is that they played something similar to a let's get scale game and accept a certain level of inferior economics on the front end, but it'll work out on the back end for us. And it didn't exactly play out as planned. And I just find it interesting because that kind of goes against, again, what I was saying a moment ago on the certainty as a kind of driving principle. This is an interesting example of how that showed up in a way that didn't work great. In terms of other things that changed, it's hard to think of. I mean, one thing where they certainly evolved their views over time is with Geico and telematics and auto insurance, which, that was less than changing their opinion and more just finally admitting they were wrong type of thing. But that's a really interesting part of the discussion in the book too, I think, and something obviously that still is relevant today.
Yeah, that makes a lot of sense. And then I'm curious in that theme of change, like in going through the exercise of compiling the key insights here, do you feel that you have any changes for yourself as an investor? Like, is there anything that you're like, wow, I should maybe think of this a little differently?
Yeah, and I don't want to keep coming back to the same point, but it's very relevant to at least how my evolution as an investor has played out, and it gets to quote unquote out value investing as a lot of us think about it, or at least how I traditionally started in this game. And you can think of CPG companies, you can think of cable companies, something that's different in a lot of ways, but even something like a fever tree, where the economics today are quite a bit different than what the business looked like, call it 5 years ago, for a number of reasons. But again, it's this idea of thinking about what is value actually, and how does that get expressed over time, and how important are things like the composition of revenue growth, as an example, the mix of volume and pricing, and what are the underlying variables that build kind of the TSR, or an EPS type of figure. If 80% of the contribution to EPS growth is coming from share repurchases, how do you think about that? Is that good, bad, and different relative to a company where the equation is the inverse of that? Thinking about those things in a way a bit more intelligently, or at least thoughtfully, than I used to, or at least I hope. And then again, thinking about, okay, what is growth, and what are the actual kind of costs or inputs to get there? What's the risk reward on that? Just thinking through those things a bit more intelligently. All pretty standard stuff, and but all things that I think you kind of have to learn firsthand. And you see them when, as they've always said, right? Better investor because businessman, and better businessman because you're an investor. And I think those two things are just really thinking about these things in terms of the actual dollars in and out, and also how these decisions, to the extent that you take them or don't take them, impact your competitive position. I mean, big tech right now, the hyperscalers are thinking about AI, right? Like, there's a very relevant example of strategy and capital requirements, et cetera, being very clearly intertwined without the answer being 100% clear at the outset, right? So it's just a very interesting part of how the overall game works on capitalism, investing, and running a business.
Yeah, no, it's really interesting. And, when you're talking this through, it's really insightful the way you put it all. And it's somewhat, I think, relevant to think about hitting, the science of hitting itself. I mean, in all of this, you need a lot of reps at the plate in order to know if you're doing things rightly or wrongly. You need to get in the batting cage and do some of your practice, but that's a lot harder to do in investing. And we could do stuff like read Buffett and learn from Buffett, but also, like, the way the game's played changes a lot over time, and it requires different approaches. And I just think about, um, if I remember some of the key things from the science of hitting itself, it's like, line drive swinging, use the opposite field. But today it's all about, um, is swinging for power and being a pull hitter, so much so that defense alignments have changed. But now they changed the rules on defensive alignments, and people are starting to appreciate hitting to the opposite field again. But through it all, there are certain fundamental truths that, like, don't change, in terms of how you, like, the approach at the plate, and how what your setups are. And I think when I've followed your newsletter, it's interesting. I do feel like you have defined for yourself some fairly clear circle of competencies. And I feel like that's maybe, Buffett's pushed the boundary of that a little with his forays into tech, but really, is you could even view Apple as like a consumer investment, and TMT and consumer being like some kinds of constants for your coverage. And it seems like with Buffett historically, consumer definitely plays a pretty prominent role, insurance, financials, and whatnot. Yeah, I'm kind of just like thinking through in my head, but I'm curious, do you have any feelings on is that a appropriate definition for your circle of competence, or did I kind of like go a little out of my bounds here?
No, I think that's fair. As you were talking, well, first of all, attempts at the plate, I was thinking it is an interesting part of being the combination of long-term and concentrated, which I mean, generally speaking, I think is a fair description for how Warren's done things. And for myself, I think it's something I try to replicate, generally speaking. At least, especially when you look at the size of the positions, right, in terms of how he's implemented certain things. There is a downside of that in terms of the reinforcement and the learning that you get if you're someone who's getting 50 or 100 reps a year versus someone who might get 50 reps their entire life. In the game of investing, you're having less opportunities to learn, right? So I think that's part of all of this. In terms of the actual security selection and the coverage, I think some of it is, and again, coming back to Warren and thinking about something, comments like if someone offered 3 times what a wholly owned business was worth, we wouldn't sell it. Or, the way he's dealt with particular positions like Coke and American Express and a few others. There's been some counterexamples certainly in the last couple of years. Wells Fargo, what he's doing currently with Apple is half of an example or half of a counterexample. But my point being, just in terms of actually finding that combination of one, man I trust and who are hopefully going to be around for a decent amount of time, and then two, a business and kind of industry structure, a backdrop that I think is supportive of this being an attractive place to fish, or to play for years and potentially decades to come. When you really start applying those filters somewhat stringently, it just becomes difficult, at least for me, to build a particularly long list of things that I think I'm going to be able to own, and particularly own in size. I think you can constrain yourself a little bit if you push too hard on both sides of that, a minimum position sizing, and also what decile those, what percentile those people need to pass on those filters, right? So that you have to be thoughtful about how you do those things. But you do, at least for me, you push yourself in a place where you have to really start to think about, okay, how many opportunities are there here that I can identify that pass those tests? And then obviously you also need to think about, okay, well, given the answer to that first part, how do I then think about what it even means to trade around these things? Or, something goes up 20%, what does that mean to me versus someone who maybe willing to have 100 positions at, various sizes? It presents a lot of interesting questions that in some cases are less clearly chosen answers versus something you're kind of forced into, right? I think it's interesting to think about that stuff as part of all this. But yeah, so I'd say the companies that I follow generally are the ones that I own, are the ones that I'm hoping are doing a good job at passing those kind of two main tests. And in some cases, I think it's pretty clear that they do so. But the prices, at least at this point in the market cycle, certainly reflect that more so than they did at one point in time. And then there's others where the answer may be a little bit less clear. And then hopefully the valuation is at least accounting for that factor, if not significantly over accounting for that factor. So I try to balance it between those two in a somewhat reasonable way. But what that means in terms of anything it's pretty arbitrary in a lot of ways. It's not well defined mathematically or otherwise. I think it's a bit of fool's errand to say that it could be.
Hey, Alex, I have a question because Warren and Charlie have talked a lot about investing in great businesses, moat, and so forth. So there's a lot on that out there. But Berkshire has also invested in some commodity businesses like PetroChina or Occidental Petroleum more recently. Do we have much on that kind of investing, where basically you're buying into a business that is highly driven by an underlying commodity price? Or have they really not talked about that as much?
It's the kind of thing where, in my view, they've certainly downplayed it. I don't know if I'd go as far as saying they don't have any views on the topic. But I think they've at least downplayed it publicly in terms of how it informs their investment decisions. I mean, on PetroChina specifically, which I cover pretty extensively in the book, it's on I'm looking at it now, page 222. I think Warren pretty clearly lays out that the thesis effectively boiled down to, on the right comp, it traded at something like a third of the the price that the majors were trading at in the U.S. And the other key variable was PetroChina had very clearly said that they were going to pay out, I believe it was 45% of earnings as a dividend. So he had, again, like I was saying before, he had confidence on the two variables that he was focused on in terms of having certainty around the price and having certainty on capital returns, and obviously those two variables in connection with each other. So from the discussions that I can remember, at least off the top of my head, that was the much more important part than anything that related to the price of the commodity or something like that. I'd have to pull up. I have sections in here on Occidental, but I honestly can't remember off the top of my head.
Yeah, that's helpful. Thank you. Also wondering a little bit on turnover and kind of the decision to sell, because I guess the party line is kind of we hold things forever, but obviously there have been sales, some even after not so long of a holding period. Do we have statements around the rationale for some of those sales?
On specific ideas, they've even when asked directly, they almost never, from what I remember at least, I almost never directly comment on the given business, or obviously if they had a problem with management. It's not in the book, but Warren did specifically comment at the Federal Crisis Inquiry Commission. I remember this from people can go pull up the transcript. He talked about selling, I believe it was Fannie and Freddie, around the turn of the century, and he details specifically why he did that there. But that's the only example I can even think of where they've talked about specific companies. Looking right now on page 24, they say that the kind of usual thing, if they lose confidence in management or in the durability, the competitive advantage, if they recognize they made a mistake, basically they'll sell. And I think Warren added at the meeting in 2020, I think he announced, can't remember the exact time of how this worked. You guys may remember, either the morning of or something like that, they announced a meaningful cut to the airline equity positions they held, which I think was fairly sizable in total. It was something like $5 billion. If I remember correctly. And he was asked by Becky Quick of CNBC about that decision, and basically said, when we decide to sell something, we decide it's time to start selling. We're not going to be trimming or doing stuff around the edges. We're going to get out, which I thought was a interesting comment. Again, like most things in Berkshire, you can then look at actions elsewhere and see where that differs. And I think it requires some thought on maybe the perspective on a $5 billion cumulative position in the airlines is a bit different than Apple, which was at something like 200 billion, I believe, at the peak. So maybe the thinking is a bit different there, but I think the general idea they're trying to get across on how they think about selling comes through pretty clear in some of those answers.
Taiwan Semi was one of those ones that really surprised me, how quickly they turned around after nailing the bottom, and then it would have been a great return to hang on. But
that's why I think he was pretty transparent about why they sold, right? If I remember correctly.
Geopolitics, right?
Yeah, that was another one where he basically said it in a way that he normally kind of hasn't.
What was a little odd to me about that is it's the kind of thing that you don't buy in the first place if you're that concerned about geopolitics, I think.
Fair.
Maybe I'm wrong on that. One of the things I thought you said was interesting about like the Wells Fargo sale in contrast to holding American Express and Coca-Cola was the invocation of industry structure, and finding, and I think you were saying it for yourself, like finding an industry structure that has some certainty that you could believe in and underwrite against. And I think that stands out with the Wells Fargo sale, where I don't even know if it's the specific problems at Wells Fargo, but you could point to selling of other banks, like Bank of America stake's been sold down. He's long been gone from Goldman. Like, it just seems to be less focused on the banks nowadays, even though they've been a cornerstone of the portfolio for a very long time. And it does seem to boil down to industry structure in some ways. Maybe talk a little bit about how you use industry structure yourself and thinking through some of these things, and anything you'd want to say on that.
No, I think it's a fair point. I think as people have speculated about what Warren's doing in the portfolio for reasons of what he wants to leave to his successors, right? I don't think that financials have typically been talked about as much in that discussion, but it's I just pulled up page 439 from the book. The first answer I have on financials and banks start with Charlie saying, we're especially prone to get uncomfortable around financial institutions. Then Warren responds, we're quite sensitive to risks in banks, insurance companies. I just think there are a certain type of business where I think there's probably some credibility to the argument that Warren, he may have changed his views generally about banks. He may also have a certain unease about leaving a sizable position in a bank, someone who may or may not be as comfortable with it as he was, which I guess they could just turn around and sell it, right? But maybe he thinks it's, maybe he's had discussions internally where he says it might be better just to do it on his own. So I think that could be part of it. My personal experience in banks has been not great. Is probably the simplest term to use. I've owned Ally Financial for a little while now, which I think is an interesting situation. There's components of what they do on the deposit side of the business. Term deposit used fairly loosely there, because it's mostly online savings account type stuff where they have to compete pretty vigorously in terms of what they're paying for those deposits. So it's very different than a Wells Fargo or BAC or someone paying you 20 bips, right? They need to actually pay for their deposits, but they're going through an interesting phase right now, where as they're figuring out their position on the lending side of the house, in some of the non-core stuff, and also in their kind of core used auto business, it's given them a little bit more flexibility to think about where do we stand on the relative ranking on pricing relative to the top payers, and what does it mean for our business if we're 10 bips below, call it the top decile, or if we're 30 bips below the top decile, what does that mean for our franchise? So it's an interesting situation. And I think there's certainly evidence in terms of what they've done on the deposit side over the past 10 plus years that would suggest it's a somewhat advantageous position, albeit, again, somewhat different than kind of how you would think about a normal checking customer at Wells Fargo or BAC, generally speaking. But yeah, it's a tough industry, right? Especially if you don't have a lot of confidence in management. My experience has been you're just constantly sideswiped by things that, at a minimum, require some digging if they're not pretty significantly concerning in terms of macro factors, or in this case, volatile used car prices, credit quality, what's happening with NIMs, et cetera, et cetera. There's a lot of things going on, and like in most businesses, maybe more so than most businesses, having someone running it that you really, really trust then becomes very, very important.
Yeah, well, all those themes, let's use this to segue into another company that I've really liked your coverage on, and I think it has questions about industry structure, leadership, a lot of evolutions going on. Disney, right? Disney's been one. I think you've had a really level head about it all. And I know it hasn't exactly been the easiest company to stay with, but maybe talk a little bit about the industry structure, how you see that evolving, where you think it is, like what inning of the evolution are we in right now? Because we got to use baseball terms here. And, how you think about leadership and what it might look like in a post-Iger Part 2 world.
Yeah, it's a fascinating question. I mean, I think it's probably helpful to give a short background on how I got to here with Disney, but also the industry generally. My first investment in this space was 21st Century Fox, which is probably about a decade ago now, if I had to guess when that position was initiated, maybe a little bit more recent than that. That eventually led to the Disney deal, which I took equity in the deal. At that time, or at least preceding that time, my typical view was of one that was shared by many value investors, I believe, which was Netflix's valuation was crazy. They still had obviously a lot to prove on actually generating consistent operating profits and free cash flow. It was very much doubtful that it was actually going to be worth $50 billion, whatever the number was at that point in time. Fast forward a couple of years so I own Disney all throughout that period, to be clear, and still do today. Fast forward to early 2022 when Netflix started seeing some material growth pressures, and as is often the case, it flowed through other parts of the P&L. So it was a pretty drastic hit to near-term earnings estimates, near-term free cash flow estimates. I had been following the industry for long enough, and particularly following Disney's trajectory and throughout that period of the prior, call it 3 years of their transition to D2C, to I think have pretty clear sight in terms of what Netflix going through, being kind of a canary in the coal mine for what everybody else was going to face in the not too distant future. And as opposed to it being kind of a negative event for Netflix specifically, it was probably indicative of something that was going to actually lead to an even better industry structure for them, and something that would benefit them enormously over time. Other things have happened subsequently, but I bought around that time and added more a couple months later. So that investment's worked out incredibly well, which has also informed some of my thinking about Disney today. And thankfully I had one that worked well to offset the Disney position, which surely has not worked well. And, I think it's pretty clear from looking at, and I kind of included this in the last write-up, it's pretty simple at the end of the day when you look at a company like Disney, and earnings estimates for, I believe, next year are basically in line with what the company earned a decade ago. And as I think I wrote last quarter, it's hard for the stock to greatly outpace an EPS number that's flat over the course of a 10-year period. I think what's happening now, if we want to kind of back out the experiences business, which I personally have a lot of confidence on, and I believe it's a very unique asset that, if they continue to manage it well, will continue to grow in value over time. I think what's happening now is, well, one, the company, their D2C strategy in entertainment programming was pretty clear from the get-go. They did have to deal with the channel dynamics of movie theaters, basically, and then obviously, rentals and other video purchases digitally. But the channel dynamics for D2C were fairly straightforward in terms of what they were asking from people and where that content was coming from. The harder part has been, specifically on sports rights, is thinking about live content and what they ask people to pay for accessing that programming, particularly given that there's a huge portion of it that still is exclusive, basically, to linear. So long story short, they launched ESPN Plus in 2018, and my contention for a while has been the strategy at ESPN Plus hasn't actually been solving the problem that they need to solve, which is how do you manage ESPN proper in a world where distribution is changing in a significant way. I think we're now at the point where they're finally getting in a position to effectively go about answering that question, and they've basically changed their frame of reference on what the key question is. So that's a pretty significant development. And I think we're potentially getting to a place, without going into too much detail on all this. I've written about this many times. People can go read it. We're getting to a place where the story, in my mind, is starting to look a bit more like what Walmart went through over the past roughly 10 to 12 years since Doug McMillon became CEO, and the P&L pressures they went through, but then also what has happened on the back end of that, and then how the markets responded to that. I think there's a lot of similarities here. So I think Disney's at a particularly important point in terms of the video businesses bottoming out in terms of cumulative profitability, and now having a clear path forward. And they've got in a much better position on pricing, but still a lot more work to do. They've started to get in a better position on product structure, basically, in terms of putting everything in one app and having thoughtful bundling. There still needs to be work done there as well, though. But they're in a much better place in terms of kind of answering the fundamental question. And I think for people who are subscribers to Disney Plus, it's probably instructive, or at least it was to me a couple of days ago, to pull up Disney Plus and think about how what they're showing there and what they're programming now, how that looks relative to if they used it when it first came out in 2019, how it looks compared to at that point in time. Then you got to step back and ask yourself, should the ARPU for this product in UCAN be $8 a month or whatever it is? That's not a perfectly clean way to look at it because of the Hulu and ESPN components of that bucket. But I think you can start to get a sense for where that business is going. And to the extent that they stick the landing, EPS will not be flat a decade from now. I think we can say that with a reasonable degree of confidence.
I really like that Walmart example you give because of what a lost decade looks like, because how much change can happen beneath the surface, and specifically, you pointed at EPS being flat, but really, flat as it may be, it's also very different now with far more coming from experiences than in the past. So there's been a lot of change amidst what looks from the surface to be fairly flat results. And then, you kind of like fast forward into, well, before that, you look at industry structure, and it's like this company is being completely driven and valued off of still being just a legacy. I'd say a linear, not even a studio-driven company. Partly because of what happened during COVID when that business was like kind of quiet, but very much valued based on the trajectory of linear TV in terms of market direction. Not necessarily the exact comps of someone like Paramount on multiples, but like the way the stock trades, it's very similar. And so like when you could take your step back as you're doing, I think, and view it through a different prism, it's kind of helpful. It cuts through the noise. Do you think? I think one of the big questions a lot of people have on value is what happens to ESPN. The leagues keep demanding higher and higher prices. You have the hyperscalers and maybe Netflix who have a lot of money to work with, who want to get into these businesses one way or another. And there are questions about whether Disney can and will keep bidding, or when they do, can they transfer higher prices to their paying customer base without having the linear bundle to draw on? Like, what do you think that looks like? Do you think ESPN can become like this center for sports?
Yeah, I think it's a really interesting question, and I think I wrote an article. This is back when I was still writing for Guru Focus, I believe. I wrote an article about the future of ESPN and talked about this idea of it. I think I probably loosely just described it as the Netflix of sports, specifically in the U.S., right? And talked about the opportunities they had ahead of them in terms of, there's something that was really notable. There's obviously these smaller conferences and an endless number of football games, basketball games, college soccer games. There's thousands and thousands of events, over the course of the year that could be programmed somewhere, and obviously wouldn't have a ton of viewership or have a ton of value, but it could for certain audiences at the right time, right? And there was a way to do that more intelligently. And also thinking about out of market packages, which there's certain leagues where that's still not being thought about the most intelligent way, I don't believe. But there's some where they have moved to a model that works with, it happens to be ESPN Plus in this case with the NHL, but it could have been another distributor, but it's them modernizing how they think about that. And that's kind of where the article was, the idea that it was going towards was it's not 100% the same as entertainment programming in terms of the value that comes from this D2C streaming environment. But there are a number of things that make it more valuable than a customer to the bundle having the choice of a handful of ESPN channels. And again, choice, some of those, where you can access it, et cetera. Some of those things do have value. But again, as they ran that strategy over the past 7 years, I think they got off course with how exactly they were going to do that. And part of it, in my mind, comes back to a fundamental question of what is this stuff actually worth and how many people care about it? And then how do you go about monetizing that and making it work? I think it got off course in terms of them being willing to be comfortable with linear just being the thing. And I guess, people could authenticate and watch it through Charter or Comcast app or something like that, but it isn't nearly as convenient as them going out and actually creating a product to consume these things digitally. And, I think there is an open question how much audience has been cut off as a result of that, or how much the audience has evolved. So again, they fundamentally have to answer the question of what is the size of the audience in the U.S. and how much are people willing to pay for it, and then obviously can you put a product around that deals with really important questions like password sharing being a notable one, and also when you have partners like YouTube TV and others, are they addressing those questions in a way that is suitable, and that is something you should require as part of your business, obviously, right? When we come back to the numbers, ESPN domestic today is just shy of $16 billion TTM revenues, and that number is as high as it's ever been. The growth rate of that obviously is under significant pressure if we're just going to stick to a world of linear falling, call it high single digits every year. And if you cannot get sufficient pricing on the other side, one of my complaints has been that their price gaps to someone like Fox is something that they can't allow to stand. The value composition of the bundle has changed, and they need to be more forceful about how they command that. But again, they have had issues of their perception of trying to push people to different buckets of distribution, in my mind, has impeded some of those probably pricing discussions. And they needed to have a clearer focus of, our goal is as much distribution as possible, as much access as possible in a way that makes sense to the customer, and then providing a certain level of selection and segmentation that allows us to basically maximize the opportunity here. To the extent that they do that, I think we'll see over time that the rights that they have can support the level of revenues that they generate today, and then some. The other reality of this business now is, particularly with the new CFO who has a lot of experience playing this game with Wall Street, is they have pretty explicit targets now for the next couple of years on profitability, and they're going to have to make decisions about what is or isn't kind of core to them. And I think you're seeing that now in terms of F1 or the MLB or the UFC. They have some important decisions there on what truly is needed as part of their linear offering, ESPN flagship, et cetera. So I think it's a question that is very relevant for ESPN, obviously, but I also think it's kind of relevant more broadly. I personally think that part of the answer may be that for some number of people in the US, a number that I personally would say is tens of millions of households, the idea that ESPN's collection of rights is getting something $15 or $20 a month significantly undervalues the value that they provide to that subset of customers. I mean, obviously, you have to make some adjustment if we're talking about 20 million versus 65 million pay TV subs. But I think there are opportunities here for a certain type of sports fan. The pricing is going to need to be quite a bit higher than it is currently. But yeah, we'll need to see how this all evolves. But I think they have a good position, generally speaking, to make this work, as long as they have a sensible strategy.
That all makes sense. One thing that I find interesting amidst this whole debate, too, when it first emerged, when people first started freaking out about ESPN, I think it was like 2016-ish, 2017, there were some like ominous signs on sports viewership itself, and questions about how millennials and Gen Z would inevitably consume sports, whether they wanted to watch whole sports or if, they just consume bite-sized highlights via social media. And one thing that the last couple of years have proved out is that actually, like, people really do like sports. They will watch a lot of sports, and ratings and getting an audience are definitely not the problem. So to the extent that was one of the pillars of the bear case on this all, that's just not there. And I think you make a lot of really good points on how to pull it together. Yeah, go ahead. Sorry.
No, real quick, I was just going to say on that point, I mean, the other really important part of this discussion is the pricing at one point on 100 million households was based on what 100 million households are watching, right? And we're down to 65 million now, and unsurprisingly, or I guess you could make the correct assumption that of the 35 million that left, they over-index to people who are not sports fans either at all, or obviously not religiously sports fans, right? So what they provide in terms of the customers who are remaining is more valuable than it's ever been. And that view needs to be, in my opinion, needs to be expressed more forcefully to distributors. And yeah, there's other opportunities around this that they've that again, ESPN's or Disney's strategy has been, in my mind, lacking. Gambling's a very prominent example where they didn't have to play in it directly, but they needed to make more clear and meaningful decisions in terms of how they're going to play here, particularly at a point in time when it was really, it was really a hot industry, for lack of a better term. And I think they kind of just misplayed their hand. So it's just one example of things that they need to do better at in order to be successful here.
Well, relatedly, do you think, in linear, it made sense to, under one corporate umbrella, own several pieces of the bundle, but perhaps in this future world, or maybe the current world, you're better off as ESPN, a standalone company that's not tied to the House of Mouse and can move more decisively into something like gambling, which doesn't fit well under the Disney umbrella?
Yeah, I mean, absolutely. My contention for at least a couple of years now has been they need to pick a strategy between something that's effectively an all-in bundle, something that is going to be broadly of interest to tens of millions of U.S. households, where between their combination of entertainment programming and live rights, they have good reason to believe that they can get ARPUs that are, call it, north of $20 a month all in. Or they needed to find a way to effectively get out of sports and to run something closer to a pure Disney IP branded strategy. And part of it is an ARPU question, but a huge part of it also, and it gets to why Netflix is now in WWE, right? And the results that we've seen from that early on. Part of it is this question of how do you get, not everything's a Super Bowl, not everything is a Monday Night Football game. How do you get stuff that people might be willing to watch, but that they're not necessarily going to search for, especially to make them jump through a bunch of hoops? How do you get that onto a screen somewhere that will be of interest to them and they'll click on it and watch it? I mean, it requires people obviously engaging with your app multiple times a week, if not every night, right? And it's a position that Netflix is obviously doing very well with and capitalizing upon. It's something that Roku is now doing very clearly, right? The results for Roku channel have been very, very impressive over the last probably 2+ years at this point. I mean, the latest Nielsen data, the Roku channel's viewership share was just over 2% of US TV time. It roughly doubled over the past year. And, that 2.1% share compares to Max, Peacock, Paramount Plus, et cetera, at, basically 1.5. So how does the Roku channel outcompete these companies on viewership share when those companies are spending billions and billions of dollars on content rights? And also, why is the Roku channel doing things now like the X Games? I just think it's revealing in terms of the question Disney had to partly answer was, if we're going to be in sports, how do we justify paying for all this stuff? And part of the answer has to be a certain level of discovery and viewership that in my mind is really hard to make work as a standalone expensive, the zone type of like sports app. That's just really difficult to do. You can get maybe tens of millions, low tens of millions of hardcore sports fans to sign up for something like that. But it's hard to draw in more casual viewers, which I think you need to kind of effectively monetize this stuff in a way that will be competitive with, an Amazon or a Netflix, basically.
Yeah, the Roku channel example, I think, points to the power of owning distribution in this new world. And to the extent that Netflix has built dominant scale, they don't need to worry or think about distribution, but Disney still does, because it's not top of mind necessarily. They haven't built that habit. And people still, I think, I don't know, just looking for my own kids' behavior, it's like they have very specific things they want to watch on Disney, but when they want to mindlessly find something, they'll go to Netflix or worse, YouTube, but I kind of have banned that for that purpose. But like they don't do that in Disney, and I think it's on the one hand a lack of enough content. There's not enough content to make that your first stop just yet. And on the other hand, it's just not ingrained habit at this point.
Yeah, absolutely. And again, it gets to some of the annoyance of their D2C strategy generally over the past 5 years, right? And it's really prominent now. And I've written about this in detail for people who care to go look, because I don't know the numbers off the top of my head. But how they've priced the individual offerings and how they've priced the bundle, and what that led to, most notably in terms of the trio bundle subs, people who had Disney Plus, Hulu, and ESPN Plus. Again, at a point where ESPN Plus, generally speaking, had long tail sports rights that are not going to be of much interest to someone who's not particularly interested in, like European soccer, bunch of college sports rights, and not the marquee stuff, generally speaking. Just stuff that, again, is a little bit more fringe. You have to be more of a hardcore fan. But they managed to get the trio bundle subs to, I think it peaked at just north of 20 million households on a US product, which is, again, is not on par with where the bundle's still at even today, but that was built over a fairly short period of time. And what's happened subsequently is they basically de-emphasized that product for the sake of now pushing their entertainment programming bundle, Disney Plus and Hulu, because they're really getting to the point where they're going to collapse these in a serious way, which is very difficult to do. I mean, there's always, for me, a lot of it comes back to thinking about Netflix's position and its strategy. We were talking about industry evolution, right? I think part of the answer on industry evolution is that with each passing day that companies who are in the losing positions effectively or in the need of improvement positions, each passing day that they don't rectify what is in need of improvement, their challenge becomes that more difficult. And a very notable example is when a company like Warner Media teams up with Discovery. Well, at the time of the deal, Discovery Plus is basically a meaningless business. It had a few million customers, basically. They can effectively shut that down with very little consequence, most notably financially, right? For Disney to turn around and shut down Hulu is not nearly as easy to do, and it requires a lot more thought in terms of how they bring these things together. So again, I think it just speaks to the clean nature of Netflix's strategy, in terms of basically, here's a single product. I mean, there's different tiers, but here's a single product that you can buy if you want our content, or don't buy if you're okay with not having it, is a position that's a lot easier to build from than Disney, who's gone through these waves of different ideas. And even now they have their sites are pretty clearly set on, I mean, surely for entertainment programming and probably for their live rights as well. Their sites are set on a single offering, but they're still struggling with how to actually implement that to get it in a position where they can focus on what they really need to going forward. So again, it's just really interesting case study. Again, similarly to Walmart in retail and e-commerce and omnichannel, when you miss a really important change in your business or industry, like what are the costs that you then have to incur to try to play catch up? Both those companies would suggest the answer is something on the order of like a decade worth of time, and very significant P&L and cash flow pressures as well.
Yeah, that Hulu question, like how do you get to one platform, is something I didn't fully appreciate at first. And I'd had these conversations with some people who worked at Hulu and at Disney. And I think because of the way in which Disney basically rushed out D Plus as a platform, it's not the best tech stack. And Hulu has some really great pieces, especially on the advertising side. So as much as you'd want to say, like, just shut Hulu and get everything on Disney and have one platform and go to market with that, there are really tough questions and trade-offs about which pieces should be ported over and which pieces shouldn't, and how do you even do that within the parameters of the tech that's in place today.
Absolutely. And just real quick on that point, because one of my key learnings on Netflix that I've written about, when I first realized it really stood out to me. If you look at their P&L and think about the margin expansion they've had over time, really in the last 10 years, obviously, if you look on a dollars per sub basis, and obviously there's been very significant subscriber growth, the differential between revenues and cost in terms of how they actually got the margin expansion has been almost entirely attributable to pricing. The COGS and OpEx components of those buckets on a dollars per sub basis has not levered in any meaningful way. Point being in saying that, like you're talking about on Disney's basically, infrastructure or Disney Plus infrastructure, Netflix was spending a significant amount of money on tech and development and marketing, et cetera, and they're spending more today than they ever have previously, or near as much as they've ever spent previously, right? Like the bar was high and the bar has kept rising, and that's what makes these things, again, like someone like a Walmart, which was in a really strong position, generally speaking. I mean, they're basically the grocer to tens of millions of US households. And that was the best part of retail to be in if you were going to get sideswiped by e-commerce. And even they've had, a very significant hill to climb in terms of figuring out what to do in e-commerce and omni-channel. And, they've now, in my mind, largely settled that question. But it took a while to get there, many, many, many years.
And along the way, you go from 10 times earnings to 40 times earnings in that evolution.
Yeah. I mean, I think that point to me kind of gets back to, I mean, not defending the multiple in any way, right? But gets back to this question of certainty and why the market does the things it does at times. And, we'll see how it all plays out. But I think if someone's been watching, basically, if you invert the question, say, well, what's the time to buy Walmart or own Walmart? I mean, I think if you look at where they're positioned today, the last couple of years they've had something like mid-single digit revenue growth. The margin structure hasn't started taking off in a way that has probably lived up to what the street or certain investors probably want, but they are telling you and have good reason to be telling you the pieces that are in place for, again, margins, the consolidated margins today, I think, are down something like 300 bips from where they were 15 years ago. And they were only at, 7% 15 years ago. So going from 7 to 4 or 7.5 to 4.5, whatever it is, it's a very significant change in terms of operating profits, right? And I think their commentary now would say to you, what our business model was before, the margin opportunity in that business is inferior to what our margin opportunity is with our current structure in the fullness of time. So long story short, I think certain market participants probably look at this situation and go, I have as much confidence as I've had in a very long time that this is a retailer that is going to hold and probably expand upon its position in the retail marketplace, which can afford something like mid-single digit revenue growth. I'm confident that I'm going to get the margin pull through. And I think with effective capital allocation, that is a scenario where I'm looking at something like a, core, like inclusive of repurchases and dividend, a core TSR of at a minimum, probably 10%, if not approaching low double digits. And I can pull that string for a long time. That doesn't look like the worst thing in the world when as well, or, particularly if you're the companies you're kind of comping that against are, not to come back to this for the fifth time, but like some of the legacy CPG type companies, right? Or if you're looking at cable companies, and again, I'm not necessarily defending the multiple, right? But I do think it's somewhat instructive in terms of like the value that the market is placing on certainty to kind of bring this full circle.
Yeah, and to keep the full circle thing going, I mean, talk about bad timing. I was looking at this today because we're recording this on the very day Walmart reported earnings. But Berkshire owned Walmart through a decent amount of the sideways years, and then basically sold most of their shares right before Walmart really took off and the market started appreciating the transformation beneath the hood. And, as I, a shareholder in Disney as well, sit here waiting for the turn, it is something that I was thinking about. And, it does seem like Disney could be this kind of stock as they move through this evolution that Berkshire could look to kind of get in at a more appropriate time than they had gone out with Walmart. Just a thought.
No, it's Warren's. There's two very the Walmart position, which I believe was reasonably decent. I mean, it wasn't huge, right? But I think it was a reasonably decent sized position, and has not gone or did not go great. And then another very prominent one, Warren saying, I believe it was at the 2000 or 2002 meeting that basically, hey, Charlie's on the board at Costco. It's this great company. He wanted to buy it and I missed it. And, we've missed it. And that was 20 plus years ago. And he didn't miss it. It turns out. And there were opportunities to buy it, right? Where the valuation was on kind of traditional, whatever metrics like PE or something, was at a level where I think he could have got over the hump. It's just a funny example. And, there are examples of this like this throughout the book where some of the answers I'm kind of like pointing at things that are interesting that Warren or Charlie said that didn't look too great in hindsight, or maybe their answers on something changed over the years. And obviously I'm doing it all out of the position of like, hey, these guys are maybe not necessarily in the reader, but I know they're a lot smarter than me. And it's interesting to think about when they've gotten certain things wrong over time, or where their answer has proven incorrect. Like, why was that exactly? What part of it could they maybe have thought about a bit differently? Missing ideas and then not really giving them the fair analysis at future points down the road is certainly one of those things. And I'm sure many people would agree with me, but it's something that I have also struggled with as an investor, right? It's really hard.
Yeah, that was literally what I was thinking in my head. The one thing that I could say about it is this is hard. This thing is really hard. And they've been incredible. And I think it really comes through in some of the anecdotes you tell at simplifying, demystifying, and speaking with candor about all this stuff. I think that's like, basically, it should be all of our starting point in approaching what is incredibly complex and incredibly hard.
Yeah. I'm just looking now. Obviously Warren didn't have this at that time, but Walmart provides a clean CapEx allocation for their US business. I think they lump international in one bucket, but I'm looking at from the period from 2000 to 2014, what they define as IT distribution and e-commerce CapEx was basically unchanged at $2.5 billion a year. And then fast forward to last year, a decade later, it went from $2.5 billion to $12 billion. New store CapEx went from, it was right around $4 billion to effectively zero. Point being, and it gets to something with the mega cap tech companies and the hyperscalers, right? Like the nature of the bet changed, and they were right to change the nature of the bet. But my sense is that someone like Warren, he really perks up when he sees a situation like that, where his ability to really confidently state that the ROI on X number of incremental CapEx dollars is Z, he tends to get nervous. And with the wholly owned companies, he has an ability to control that by saying your cost of capital is 15%, or, that they've said numbers like that explicitly in the past. I'm sure it's probably changed over time, but he could control that in a way that with a public company, obviously is a lot different.
Absolutely. And, I think on that note, I think we're good to wrap here. This has been a fascinating conversation, a whole lot of fun. And I hope we have you back as a repeat guest here, where we could talk about Disney. I know we've gone very deep in this one stock, revisited over time, but also like a host of other companies that you cover that are interesting to me, and I think interesting to our audience as well. So we're incredibly grateful that you've joined us, Alex. Wish you nothing but success with the launch of the book, and I think everyone listening should check it out. There's a lot to learn.
Yeah,
Thanks
thank you so much, Alex.
It was a great time. I appreciate it so much.
Thank you so much, and thanks all of you for listening. We'll talk to you next time.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.